UK property market is particularly attractive at the moment, really from a position of diversification. Looking across all the main kind of asset classes, it's hard to find value anywhere really, but we feel there's real value in diversification. So that's what property really brings to investors' portfolio. In terms of the market as a whole, the market is fairly fully priced and it's been quite crowded over the past 2 or 3 years. So the most traditional investment classes like retail, offices, industrial, we do find reasonably expensive. That's not to say there aren't opportunities, there are always opportunities anywhere, but really the opportunity is in the value of income, and we're kind of searching around the periphery in terms of hospitals, senior housing, student accommodation, residential, for different income streams that are kind of slightly away from the core. So we think the income returns, the income streams those assets generate, they're the ones that really offer value at the moment. The property market is fairly well positioned at the moment in terms of the main sort of fundamentals in terms of occupational demand, but also supply. So we're seeing across the UK, particularly driven by London, tenant demand is strengthening, and we're seeing rental growth coming through. We're also benefiting from a position where none of the major markets really have oversupply. So the supply-demand dynamics of the UK property market are fairly robust. So the threats mostly to property returns are really lie outside of property and things going on a UK economic and global macro basis. But the UK market itself seems fairly robust, but we don't know what's going to happen, what are the other bigger factors that might affect wider investor sentiment. Well, liquidity is the one thing that investors always ask us about. Investors want to be able to invest in property on a liquid basis, and that's one of the reasons they invest in something like the Aberdeen Property Trust. So, the way we approach liquidity is paramount. We have a proportion of the portfolio which we invest in daily traded stocks, so cash, fixed income, equities. Physical property is not daily traded, as we all know from buying and selling our own houses. And whilst investors might want the maximum possible exposure to physical assets, ultimately we have to have an eye on flows in and out of the fund and have a proportion invested in those daily traded or daily liquid assets. The outlook for the market is cautious at the moment, I'd say. We've had 2 or 3 years of very strong returns, double-digit returns out of property. Property is highly cyclical like most other asset classes, and we can't expect those levels of returns to carry on. So we would expect at some point for returns to start to moderate. Having said that, we still think the occupational markets are robust and well balanced in terms of supply and demand. So there's no immediate threat to it, but we must assume that returns will moderate at some point in the short to medium term.